Okay, so today we're going to cover the rest of the basic tax law topics that are part of working at a VITA tax site. So we've already talked about the basics of tax law. We've run through the 1040. We know what types of income is taxable. We know how to enter in W-2s and unemployment compensation, interest, dividends. Um, we know about the main adjustments we might need to take, like the student loan interest adjustment and the educator expense adjustment. We've talked about the standard deduction. We've talked about some credits, like the retirement savings contribution credit, the earned income credit, the child tax credit. And we've talked about how you end up with either a refund or amount owed. But there's some other topics that we fit into all those sections, and that's what we're going to go through today. So we'll start with retirement income. Then we'll talk about taxable refunds, education benefits, and the daycare credit. So first, we're going to return to the scope of service chart. This is from your publication 4012, right after the table of contents. In addition to outlining what is in and out of scope for the VITA program as a whole, it also indicates which tax topics require an advanced certification. You can see the example of that right here on the 1040 line 1 is in scope, and it is in scope to report wages, salaries, and tips. But you need an advanced certification if you're reporting, if the person has unreported tip income. There's some common advanced level topics that we see at VITA sites, and these will be something you all are able to do after you take advanced training and certify at the advanced level. That includes self-employment income, so any folks who work as contractors, freelancers, gig workers, itemized deductions, retirement income when the taxable amount is not determined, early retirement withdrawals with a tax exemption, health savings accounts, Form 1095A or marketplace health insurance, capital gains, sale of home, and canceled debt. These are all topics that we cover in advanced level training, but for folks who only have a basic certification, they cannot complete returns that include these topics. Everything we've already covered is in scope for basic volunteers, and in this training, we'll cover the remaining basic level topics that we commonly see at our sites, and then we'll move on to the advanced topics in future sessions. So let's get started with retirement income. Retirement income is kind of known to be a complicated tax subject, and because of that, only some types of retirement income are in scope for basic level volunteers. And the biggest distinction between basic and advanced retirement topics is if the taxable amount is determined or not. If it is determined, it's likely in scope for basic volunteers, but if the taxable amount is not determined, an advanced volunteer has to complete the return. And remember, whenever we're thinking about scope should always be determined during the intake and interview process before tax prep in TaxSlayer begins. So on the screen, you can see if you have a basic certification, you can complete retirement income with the taxable amount determined if it's a code 2, 4, 7, or B. Taxable amount determined if it's a code 1 and no exemption applies. A rollover, which is code G, and a disability payment, which is code 3. Advanced certification, anytime the taxable amount is not determined, that's called the simplified method. You can't do that unless you're advanced certified. And then any early withdrawals that have an exemption. So if a code 1 retirement withdrawal is there, if they meet an exemption, then that's for an advanced volunteer. We're about to talk about all these things, so it makes a little bit more sense how we determine what is what. So most retirement income is reported on a Form 1099-R. You can see that it looks a lot like a W-2, but it says 1099-R here at the top as well as at the bottom. This is for distributions from pensions, annuities, retirement or profit sharing plans, IRAs, insurance contracts, etc. So retirement income. Like with the W-2, all of the information that's reported on this form should be transferred to TaxSlayer. But because retirement income is a more complex tax topic, there are specific bits of information we have to close attention to. So let's talk about the information that this form gives us. Box 1 up at the top is the gross distribution. This is how much income the taxpayer received from the retirement account during the year. Box 2 is the taxable amount. This is how much of box 1 is taxable. If this box is empty, it's not in scope for basic volunteers. Box 4 is federal income tax withheld. Just like wages on a W-2, many people have tax withheld from their retirement payments throughout the year. And then box 7, I would say this is the most important one to look at first. This is the distribution code, and it tells you what kind of distribution this is. Then the checkbox next to it will indicate if the retirement account is an IRA or something called a SEP or simple retirement plan. That means it's a individual retirement plan rather than one through your employer. So think about these 4 boxes as being the most important. Of course, all the information is going into TaxSlayer, but these are the ones you need to pay attention to determine if it's in scope for you and what you need to do in TaxSlayer. Also note, while this is the most common form, retirement income might also be reported on something called a CSA 1099. That's for a civil service annuity. So typically folks who work for the government. CSF 1099, also civil service, and an RRB 1099-R. That's for railroad retirement. So someone who worked for the railroad. These are not as common to see, but you'll know their retirement based on the R at the end of the name. Okay, so box said is for distribution codes. Only certain distribution codes are in scope for VITA, and the distribution code can affect if the return is in scope for a basic volunteer. Code 1 means an early distribution. This means the taxpayer took funds out of a retirement account before they reached retirement age. And this distribution is going to be subject to a 10% extra tax. There are certain exemptions to the 10% extra tax depending on what the distribution was spent on and the account type. And claiming the exemption for that requires an additional form in TaxSlayer, which is out of scope for basic volunteers. But it's important for all volunteers to be aware that there are some exemptions because we don't want that client to have to pay the additional tax if they could claim an exemption. So you can find out more about those exemptions in your publication 4012, page H7. It's got a list of all the exemptions that someone might qualify for. Okay, let's skip ahead to code 2, 4, 7, and B. Code 2 is an early distribution with an exception that applies, but it's already determined, so we don't have to do anything extra. Code 4 is for death, so meaning they received this distribution from someone's account who passed away. Code 7 is a normal distribution, and Code B is a designated Roth account distribution. These are all in scope for basic volunteers when the taxable amount is determined in box 2 because TaxSlayer knows what to do with them and no one has to do anything extra. Code G is a rollover distribution. This means that the taxpayer took the money out of their retirement account in order to move it into another retirement account. We're about to talk about that in a little more detail. And then code 3, back towards the top, indicates a disability payment, which we'll talk about as well. Some codes, that's not all the codes that there could be, but there are some codes that just indicate a non-taxable distribution, and it's not included on the tax return, so TaxSlayer will handle that. But there are codes that are completely out of scope for the VITA program. You can see a list here, 589, A, E, J, K, N, P, R, T, and U. So just as a reminder, if you don't recognize the code in box 7 of a 1099-R, look it up. You can find a full list of these codes in publication 4012, page D50, and D52, sorry, and it tells you if that code is out of scope or in scope. All right, so let's talk about what it looks like in TaxSlayer when we're entering retirement income. Just like with wages, we're talking about income. So we're in the federal section at the income menu, and we're going to select the fourth item from the top, which says Form 1099-R, RRB, SSA. It's the same place we put in Social Security benefits, and choose, it says distributions from pensions, annuities, retirement, IRAs, and Social Security. Then the next screen, we'll choose add or edit a 1099-R. And we'll copy the information from the tax form exactly, making sure we don't skip anything, and that we've got it. So for our simple 1099-Rs with code 1, no exception, code 2, 4, 7, or B, if the taxable amount is determined, that's it. It's just like a W-2, you're just replicating it in the software. When something is a rollover or code G, it looks like you have to take an extra step. So some retirement distributions are rollovers, meaning the taxpayer took the funds out of a retirement account in order to transfer them to another qualified retirement account. This usually happens when someone changes jobs and wants to consolidate all their retirement accounts. But because the taxpayer is putting the money right back into another retirement account, the distribution is not taxed at all. We do still have to report it on the tax return, but no tax is applied. Again, you'll know the distribution is a rollover because box 7 will contain code G. Something to note, this is the only situation where there might not be a taxable amount written in box 2, and that's okay if it's a rollover and it's not taxable. So that's still in scope for basic as long as it's code G in box 7. So when we're in TaxSlayer, once we've entered in the regular information from the return and scroll down, there's a question about rollover or disability. All we need to do is check the box that says check here if all or part of the distribution was rolled over and enter the rollover amount in TaxSlayer. Typically, taxpayers just roll over the entire amount, but this is something you need to verify with the taxpayer. You need to confirm that they did complete the rollover and how much of it they rolled over. If the box is not checked in TaxSlayer, so if you don't go in and click this and the entire amount is not indicated as rolled over right here, then TaxSlayer is not going to know what to do. It's going to apply a tax, and that person's going to be paying more tax than they actually need to. So remember, for code G, you have to take a few extra steps because it's a rollover. Some retirements distributions are for disability payments. This is for typically someone who is not yet at retirement age, but receives distributions from their retirement account because they are no longer able to work due to disability. It is important for us to distinguish disability payments because if the taxpayer is not of retirement age for their retirement plan, the distributions get to be considered earned income and might qualify them for the earned income credit. So if a 1099-R shows code 3 in box 7, we need to verify with the taxpayer that they have not yet reached the retirement age for their plan. And then we know that they are able to count this as earned income. If a taxpayer isn't sure if they haven't reached the retirement age, they may need to consult their retirement paperwork or their plan manager. But for the most part, you'll know because they'll be much younger than typical retirement age. Most retirement plans age is 65, but some do differ. So back to TaxSlayer. If the taxpayer has not reached retirement age, you check the box in the rollover disability section that says click here, check here to report on form 1040 line 1H, distribution code must be a 3. Then you'll verify that the amount that was from that distribution does indeed appear on the form 1040 as wages. If the taxpayer has already reached retirement age, but they still have a code 3, you do not check this box because that's just going to count as retirement income for them. But if they are not of retirement age, know that you do have to check this box to order to potentially qualify them for the child tax credit. The earned income credit, sorry. Okay, let's do a little bit of an understanding check for retirement income. Say we have a taxpayer named George who changed jobs last year and transferred his retirement savings from an old account to a 401k offered by his new employer. His 1099-R shows $23,000 in box 1 and code G in box 7. Where does this income appear on George's Form 1040? You can tell me an answer in the chat, or you can come off mute too if you'd like to. All right, what does code G in box 7 mean to us after what we just went over? James has got us. James says it's a rollover. That's exactly right. Whenever we have code G, it means it's a rollover. And rollovers, we are not taxable. It's a tax-free distribution, must still be reported on the federal tax return, but it's not taxed. So because of this, it's on our 1040, but it is not on the taxable side. It's in the retirement, so it doesn't actually appear in the income that's taxable when you calculate up your 1040. Okay, another situation. Mary has a 1099-R with $8,500 in box 1 and box 2, and there's a code 3 in box 7. She's 45 years old and became permanently disabled on the job last year. So first, what does code 3 mean to us when we see it on a 1099-R? Nate says early withdrawal. Does anybody want to challenge Nate on that one? It is a type of early withdrawal, but what type? Code 1 is just a regular early withdrawal. Code 3 So code 3 is for disability payments. Let's go back and check out our list. Code 1, early distribution, additional 10% tax unless we have an exception. Code 3 is for a disability payment, and we need to remember that it counts as wages or earned income if the person is under retirement age. No worries, Nate. That was a great guess. And that's what we're here to do, is just continue guessing. Yep. They are swapped on the list, which is kind of confusing. I should probably switch it. But if you check it out in the publication 4012, you'll always be able to check on what these codes mean. Code 3 is a disability payment. So we know that Mary is 45 years old. She is disabled. Where is this income going to appear on her 1040? So she's 45. We're going to assume that is under the retirement age for her plan. So therefore, her income is going to appear on line 1H for other earned income. Her distribution is a disability payment and counts as earned income, potentially making her eligible for the earned income tax credit. If she was 70 years old and already at the age of retirement for her plan, it would just appear as retirement income on the 1040. But in this case, because of her age, it will appear as other earned income because it's a disability distribution. And remember, this is important because the earned income credit can be the really big part of your refund, which is a really big part of someone's income for the year. So we want to make sure that anyone who is eligible for it gets everything that they're eligible for. So making sure that when we see a code 3 in box 7 on a 1099-R, we remember disability and we check off that box. All right, so that's it for the retirement income section. We're going to do a practice return in a bit that dives into actually completing that on in the software. But for now, we're going to move on to taxable refunds. All right, when a taxpayer receives a refund on their state tax return, they might receive Form 1099-G for certain government payments, showing the amount of the state refund they got. This form looks familiar because we've already seen it for unemployment compensation. It's the same form, but unemployment compensation is reported in box 1, whereas state and local income tax refunds are reported in box 2. It's important to remember that federal tax refunds are never taxable. And for most individuals, neither are state or local tax refunds. A state tax refund is only taxable if the taxpayer itemized their deductions the previous year on their federal return and they deducted state income tax rather than sales tax in those itemized deductions. So when we do have a taxpayer who says, yes, they did receive a state tax refund, the first question we need to ask them is if they itemized their deductions last year. Folks typically know if they did or not, but if they brought a copy of their prior year return, you can check that and you'll be able to see if they took the standard or itemized deduction. If they filed at your tax site last year, you can check their return in the software. But if none of that's available, you can ask questions like, did you have any mortgage interest, big medical expenses, charitable contributions that you listed on your tax return last year? And a taxpayer may not be sure if they did, but they're very often very confident that they did not have any of these itemizable expenses, and then we know they didn't itemize. So state tax refunds, we only need to take into account if the person itemized in the previous year. The best way to determine that is by checking their previous year return, which we ask all taxpayers to bring in. But if they did not, you might have to ask them some more follow-up questions just to be sure. So if they bring in this form, the 1099-G with an amount in box 2, and we learned that they did not itemize in the prior year, that's it. It doesn't need to be reported. We just totally leave it off. But if they did itemize in the prior year, we do need to include that income in tax layer because it's taxed, partially taxed on the return. So again, if these 3 conditions, they received a refund on the state return, they itemized deductions on last year's federal return, and they deducted state income tax instead of state sales tax when itemizing, we need to go into tax layer again in the federal section. And when we click on tax refunds, this worksheet will pop up. There's 2 options. You can either bypass the state refund worksheet. That's what you have to do if they did itemize, but you don't have their return. But ideally, they will have their tax return with them from last year, and you can enter in all the information you need here. So you'll enter in the state and local refund amount, last year's state and local tax paid, which is on the prior year return, last year's itemized or standard deduction, total amount of prior year state tax withheld, and prior year sales tax deduction, and their filing status. All this information is just pulled straight off the prior year return, and when you enter it in, tax layer will determine what amount of the refund needs to be taxed. If you don't have that information, again, you just have to put the entire amount of the refund up here, and they will be taxed on the whole refund. Okay, so let's do another practice question. Leela comes to the tax site with Form 1099G showing $1,300 in box 2. And she also has her prior year tax return, which shows she took the standard deduction. Where does this income appear on Leela's Form 1040? So it's Form 1099 box 2. We know that's a state or local refund. And then we are able to look at her prior year tax return, which shows she took the standard deduction, meaning she did not itemize. So do we need to include this state tax refund on the tax return? Nate says nope. That's exactly right. It's not going to be anywhere on her current year return because she did not itemize in the prior year. The state refund is not taxable. It does not need to be entered into TaxSlayer anywhere. All right, that was a quick section. Our next section is education credits, but before we move on to that, I want to have everybody drop into the chat how you're feeling about the two topics we just covered, retirement and state refunds on a scale of 1 to 5. So 1 would be like, oh my God, I have no idea what we're even talking about. 5 would be, I'm a pro and I'm ready to prepare some taxes. And you might feel anywhere in the middle. Just want to take a quick temperature check so we can see what we want to go over again when we hop into TaxSlayer. Thanks, Nate. If you don't tell me how you're feeling, then I'm just going to assume everyone feels amazing and we won't be able to go over it. So if you are feeling like you want to do some repeat of what we just covered, please drop it in the chat. And then for now, Sadiq is going to take over for education credits.
Perfect. Thank you, Lucy. Do I share it through my PowerPoint or do you want to?
I think it'd be easier if you did, so I'll stop sharing.
Okay. Okay, I'm trying to present it to Teams. Let me know if it's working.
I don't see anything yet.
Okay. For some reason, it's not letting me present it here.
Are you trying to use presenter mode?
Yes.
So you have to open it in the desktop.
Yeah, I have it in the desktop.
Okay.
There's an option that says present in Teams to your current meeting. I'm trying to click that, but it's not.
Oh, try to instead go from Teams and click share at the top right.
Gotcha.
Just works. I don't know. Teams is annoying.
Yeah.
And then share the PowerPoint screen and it should work.
Can you see it now?
Yep.
Okay, perfect. Is everything still fine?
Yes, we just can't see the full screen. Try the bottom right next to the zoom out. There's like a little what looks like an old-fashioned projector all the way at the bottom right.
All the way at the bottom right.
Yeah, that fourth one before the minus sign. You see where you can zoom in and out at the very bottom?
Yeah.
So to the left of that, there's like a square with a little stand under it.
Not seeing. Yeah, I don't know why it's doing that.
Okay, try from beginning up at the top left. Is it full screen for you?
Yeah, it's full screen for me, but is it not full screen for you?
It's not. I think it's because you're only sharing this window rather than the whole screen.
Okay. Do you want to go through it on yours and I just talk through it?
Yep, totally fine.
Just give me 1 second.
Sorry, everybody. This is always happening for some reason. It's not with Sadiq, but with PowerPoint in general. All
Give me one
right. Can you
second.
see the full
Pull up.
screen there, Sadiq?
Yeah, just give me 1 second so I can pull up the
Great.
notes.
Yep. Just let me know when I should move forward.
Okay. Okay, I'm ready.
All
Hello,
right.
everybody. We're going to start talking about education credits today. Lucy, you can go to the next slide. So today we're here to learn about the basics, but let's zoom in on education credits. Education credits help offset the higher cost of education expenses paid during the year. The two education credits available are non-refundable lifetime learning credit and the partially refundable American Opportunity Credit. So who qualifies for an education credit? As always, there are eligibility rules. The filing status of the return cannot be married filing separately. The taxpayer cannot be claimed as a dependent on someone else's return, and the taxpayer's spouse or dependent must be have qualified expenses that are paid to an accredited institution or higher education. These might have been paid out of pocket or they can be paid via student loans. So if the general eligibility is met, we need to determine who claims the education credit, taxpayer or the dependent. Regardless of who actually paid the expenses, if the student is claimed as a dependent, the taxpayer must claim the education credit. If the student is not claimed as a dependent, then they must claim the education credit on their own. So now that we know who's eligible, let's talk about the two education credits taxpayers may claim. So there's opportunity credit meaning the Hope credit, and the lifetime learning credit. The American Opportunity or Hope credit is a partially refundable credit worth up to $2,500 per student. $1,000 of that amount may be refundable, and the AOC is worth a lot. But the eligibility is very, very specific. It is only available for students in the first 4 years of their higher education, and they must be pursuing a degree and be enrolled at least half time in their accredited institution. The student also cannot have a felony drug conviction. The lifetime learning credit is non-refundable, meaning that it can bring tax liability down to zero, but it cannot result in a refund. It can be worth up to a maximum of $2,000. The LLC is available for all years of higher education. The student does not need to be pursuing a degree. They only have to have been enrolled in one course, and there's no stipulation about drug convictions. Typically, a taxpayer will have tuition amounts reported on a Form 1098-T. In most cases, a 1098-T is required to claim the education credits. So let's talk about what that form tells us. You can click on the first one, Lucy. So box 1 shows payments received for qualified tuition and expenses. Box 2 shows the amount billed. If there is only an amount listed in box 2, you must ask the taxpayer how much they actually paid during the tax season before using the amount of the credit. Box 5 shows scholarships or grants received. The amount of scholarships or grants must be subtracted from the total amount of expenses paid when figuring the credit or the adjustment. And box 8 will be checked if the student is enrolled at least half time. Sometimes the 1098-T will have a checkbox in box 7. This indicates that the expenses for the next tax year, January through March, were paid in the current tax year. This is expenses that can be claimed towards education credit in the current year, but those expenses cannot be counted again in the following year. TaxClear asks, does the student receive Form 1098-T from this institution from its prior tax year with box 7 check? If so, select yes. So, what type of education expenses count towards an education credit? For both credits, tuition and fees are qualified expenses. For AOC, related expenses like books, supplies, and equipment needed for a course or of study are also qualified. These may not have been purchased from the institution themselves, so they are not always included on Form 1098-T. But for the LLC, books, supplies, and fees only count as qualified expenses if they must be paid to the institution as a condition of enrollment. Room and board, insurance, medical expenses, transportation costs, personal/family expenses, and expenses for non-required sports, games, courses are not qualified and cannot be counted towards an education credit. So back to TaxSlayer. In the federal section, you can find the deductions menu and choose credits, and then select education credits. Here you first click the student, and then you'll answer the questions about the 1098-T, which is, did the student receive a 1098-T form from an educational institution from 2023? And did the student receive a Form 1098-T from this institution from 2022 with box 7 checked? Then you'll add information about the institution that they attended. This should be on the 1098-T. Next, you'll enter the information about expenses, total tuition paid, usually which is in box 1, grants and scholarships that are in box 5, and any other qualified expenses. After that, TaxSlayer will prompt you to answer questions about the American Opportunity Credit eligibility, which is, has the American Opportunity Tax Credit or the former HOPE credit already been claimed on 4 prior tax returns? The next question is, was the student enrolled at least half-time for one of the academic period beginning in 2023? Did the student complete the first 4 years of higher education before 2023? And did the student have a felony drug conviction before the end of 2023? The last one asks about refundability for the refundable portion of the credit. If a student is under 24 years old and not being claimed as a dependent, they must meet a certain condition to be eligible for the refundable portion of the credit. This eligibility concerns how much of their own support they provide, if their parents are deceased, and if they are not filing a joint return. If you are preparing a return for a non-dependent student under 24, read this question carefully. After all of that, TaxSlayer will recommend the best tax credit for the return. It is usually correct, but you want to make sure you use your knowledge of eligibility to ensure that they are eligible for the selected credit. Okay, let's practice. Tyler is a sophomore at University of Baltimore and received the 1098-T. He is a full-time student and has never had a felony drug conviction. His parents claim him as a dependent. What credit is Tyler likely eligible for? Whose tax return can the credit be claimed on?
All right, so drop it in the chat if you think which credit you think he's eligible for, either the American Opportunity Credit or the Lifetime Learning Credit. And remember, he is a sophomore full-time. He's never had a felony conviction. His parents claim him. We're going to assume he's pursuing a degree as well. Here's our eligibility, just as a reminder. All right, James says AOC, which is American Opportunity Credit.
Perfect, James, that is correct. Tyler's parents can claim the American Opportunity Credit on their tax return. Okay, and on to the next one. Bernard is 38 years old and works in an IT department. Last year, he took a one credit class on software development and has never been convicted of a felony. What credit is Bernard likely to be eligible for? And just drop it in the chat. Okay, James says lifetime learning credit. Does anyone agree? Anyone disagree? Okay, Nate says he doesn't think he qualifies.
Let's go check out our eligibility.
Okay, and just as a reminder, Bernard is 38 years old, works in the IT department. He took a one credit class on software development and has never been convicted of a felony. So based on those parameters, okay, great. So Nate says that he thinks that it's lifetime learning credit, which is correct.
Good. How about you?
Awesome. So yeah, Nate, I think something that's important to think about is for education credits, as long as it's an accredited program, which is pretty much, any community college, four-year institution, et cetera. You can also just Google and make sure it's accredited. They are eligible for a education credit, and can get one of those. If they're not in that first few years of learning, then they are more likely going to be getting a lifetime learning credit, especially if they are only taking one course. They're not a half-time student, at least if they're not pursuing a full degree. All right. So thanks to Deke for leading that section. We are going to move on to our final topic for today, and that means it's our final topic for basic, and then we're going to jump into tax layer and do a practice return. So we are going to wrap up this session with a child and dependent care credit, which is sometimes referred to as the daycare credit. Yesterday, we talked about credits for kids, including the child tax credit and the additional child tax credit. These ones are automatically calculated in tax layer, but there's one more credit for kids, and that's the child and dependent care credit. And this is going to be another non-refundable credit. Remember, non-refundable means it can bring tax liability down to zero, but it cannot result in a refund by itself. So, who can claim this credit? The child and dependent care credit is intended to offset expenses paid by the taxpayer to care for their dependent while the taxpayer works or looks for work. In order for the expenses to count, the dependent must be under age 13, so they have to be 12 or younger, or a spouse or dependent who is any age but permanently and totally disabled. In order to receive the credit, the taxpayer and their spouse, if they are married, must have earned income from the year or be a full-time student. So in order to get this credit, the main taxpayer has to be working. So they must have a W-2 or some other type of earned income, or be a full-time student. And if they have a spouse, if they're married and filing together, that spouse also has to have earned income or be a full-time student. The exception, of course, is if it's the spouse themselves who is physically or mentally incapable of self-care. What expenses are qualified? The most common expenses that we are going to see at our sites are for daycare or aftercare, like after school aftercare while the taxpayer is working. But there are a few important things to remember that are not eligible. The payments, like any expenses, cannot be paid to the taxpayer's spouse, to the taxpayer's dependent child, or to any person under age 19. School tuition, so K through 12 tuition is not an eligible expense. Daycare, though, is. Day camp is an eligible expense, but anything that's overnight does not count. And in order to claim the expenses, the taxpayer must have the care provider's name, address, and their EIN or social security number. An EIN is a federal identification number. Most daycares provide parents with a form that contains this information as well as the amount paid. As always, the publication 4012 has a helpful resource to help you determine if a taxpayer and their expenses are eligible. You can see on the screen, it's from page G13, and it's called the Child Credit for Child Independent Care Expenses Screening Sheet. And it goes through these questions. First, was the care for one or more qualifying persons? Yes, meaning you can only claim it for your qualifying dependents. Did you and your spouse, if applicable, have earned income during the year? Meaning, did they work during the year? Yes, go to step 3. Did you pay the expenses to allow you to work or look for work? Yes, go to step 4. Were your payments made to someone you or your spouse could claim as dependent? You have to say no in order to be eligible. Were the payments made to your spouse or to the parent of your child who is your qualifying person? We have to say no to keep being eligible. Were the payments made to your child who was under the age 19 at the end of the year? No, go to step 7. Are you single? We could either say yes or no, and then it just takes us through next questions like filing a joint return and being considered unmarried. Essentially, again, this means married filing separately cannot get this credit. Then, do you know the care provider's name, address, and identifying number? Yes, go to step 11. And did you have only one qualifying person and exclude or deduct at least $3,000 of dependent care benefits? This is not something we need to worry about. It's not something that comes up at our site. So as long as we get to number 10 and say yes, they can claim the child independent care credit. So how do we go about doing that? In TaxSlayer, we're back in the federal section, but we're in the deductions menu, and you need to choose credits. Then you choose child independent care credit and enter the care provider's information. So their EIN, which is their identifying number, their name, address. Then you'll select the dependent that the care was for. All of the dependents that are potentially eligible will already be popped up based on what you entered earlier. And you entered the total eligible expense for that person. So in this example, we check off the kid and say that they paid $1,000 for daycare. All right, time for some of our last practice questions for today. We have Cora, who has a 9-year-old son who she claims is dependent. The 9-year-old son goes to aftercare every day after school until Cora finishes work. He also goes to baseball camp in the summer during the day for 2 weeks. And during the rest of the summer and on some weekends, Cora pays her own brother, so the kid's uncle, to watch him. Here are these expenses from last year. Aftercare was $1,050. Baseball camp was $300. And the payments for babysitting to her brother were $600. So which of these 3 expenses qualify Cora for the dependent and child care credit? Does aftercare after school count for Cora's 9-year-old son who she claims is dependent while she's at work? Yes, Trinity, that's right. Aftercare does count. What about baseball camp? It's during the day, and we'll assume she's also working while he's at camp. We can go back to our eligibility. We've got, they have to be paid for the care of the qualifying person to work or look for work. Yep. They can't be made to the spouse, dependent, child, or their child under 19. School tuition, no. Day camp is an eligible expense, but overnight is not. So does the baseball camp that's during the day count? That's right, James and Trinity. It does. Oop, I just showed you the answer. And then what about payments to Cora's brother? Her brother, so her son's uncle was watching him on weekends while she's at work. So her brother is not her dependent, not her spouse, of course, not her child under age 19. It's not school tuition. It's not overnight camp. So in this situation, as long as the babysitting is while Cora's working or looking for work, it does count, or it can count. Because Cora's brother is not Cora's dependent, Cora's brother is not Cora's spouse or own child. All three expenses fit the requirements for the credit. The important thing, though, when it's payments to an individual is you're going to have to include their social security number on the return, meaning that they need to then report it as income. So that's something she and the brother would need to discuss. Okay, one more practice question. Bill and June claim their 13-year-old granddaughter as a dependent. They pay for babysitters on days she is out of school and they are working. So they paid their neighbor, who's 35, $450, and paid their grandson, who's age 18, and also their dependent, $300. Do either of these expenses qualify Bill and June for the dependent and child care credit? And this one is kind of a trick question, so pay attention to the details. Okay, so the important thing to know here is the original eligibility. If you remember, the child and dependent care credit is for expenses paid for children under 13, for when you're working or looking for work. So because the daughter is 13, none of these expenses can be claimed. Yep, that's why I said it's a trick question. But Trinity, if she was 12, then you're correct. The payments to the neighbor could count as long as the neighbor's okay with them putting the social security number on the return. The grandson, if he's claimed as their dependent, does not count. Awesome. All right. Thanks, y'all, for participating in those questions. We are now, if you have any questions, you can ask them in the chat, or you can follow up. But what we're going to do now for the rest of training is our basic scenario number 2, Alan and Audra Allegheny. So first, we're going to need to take a look at the intake and quality review sheet. I don't know why this is popping up wrong. We're going to determine their filing status and dependents, and then we'll get started in TaxSlayer. So I'm going to pull up the return on, or the worksheet on my screen for you. But remember, you can access it too in the new training portal. So this is the link to the portal. The password is 1040. And then if you go to training materials, scroll down to basic scenarios, you'll see basic scenario number 2, Alan and Audra. Okay, so as always, we're going to do a thorough interview first, and before we move on to our next steps. So let's read the interview notes. Alan and Audra Allegheny are married and live with their 2 sons in Cumberland, Maryland. Their older son, Alex, is in the middle of his sophomore year at Towson University. He lives on campus, but was just home for winter break. Alex ordered his textbooks online, and his parents brought in the receipt. His parents paid for his tuition. He does not have a job, except occasionally babysitting his brother. He does not have a criminal record. Because Alan and Audra both work during the day, their younger son, Andre, attends aftercare until 6 p.m. during the school year, which costs $40 a week. During the summer, Alex watches his younger brother for $10 an hour. In 2023, Alan, so that's the past year, he had an accident at work, which required surgery and rehab. And so 2 years ago, they had a lot of medical expenses that they itemized on their tax return. Thankfully, this was healthy and their only medical expenses were small copays. They brought a copy of their 2023 tax return, which shows Schedule A, line 5D, Form 1040, line 12, Schedule A, line 5A, and that they did not deduct state sales taxes. Due to the accident, Alan received some disability payments in January, but now he is back at work. The entire family is covered by Audra's employer-sponsored health insurance. And the Alleghenies took some money out of a retirement account to make some improvements to their home. We've also got their identity documents. So we have the ID for the taxpayer and spouse. We've got social security cards for the taxpayer, the spouse, and the 2 children. And we've got our intake and interview sheet. So let's take a look at the interview sheet. Looks mostly filled out. We've got their name, address. They checked off that they did not live or work in 2 or more states. Both Audra and Alan are citizens. Neither are on a visa or students. Neither are legally blind, disabled, had an identity protection PIN, or had digital assets. If they're due a refund, they want direct deposit. And if they have a bank balance due, they want to pay from their bank account. They don't need to receive communication in a language other than English. They asked for information on how to vote or how to register to vote. They don't want $3 to go to the presidential election campaign fund. We see they were married as of December 31st, 2024, and they were married for all of 2024 and lived with each other for the last 6 months of the year. They listed 2 people that they live with them and support, Alex, their older son, and Andre, their younger son. We, as the preparer, need to go through here and complete this. So we'll do that when we ask the questions about dependency. They said, yes, they have wages. They have 2 jobs. So probably one for each spouse. So we'll go ahead and check off W-2s and put the number of forms. No tips. They did have some retirement income and disability benefits. So we'll need to take some notes here as the preparer. No Social Security, no unemployment. They had a refund of state or local income tax. So we'll need to ask them these questions. Did you receive a refund of state or local taxes? Yes. And did they itemize last year? Yes. We learned that from their prior year return. And then nothing else. We would double check and see if they had any of this income, but we don't need to for this practice situation. On this page, we would double check, make sure this is all correct. They did have child and dependent care expenses. They did make contributions to a retirement account. And someone in their family took educational classes. They brought us a W-2 for Alan, a W-2 for Audra, a Form 1099-G with an amount in box 2, which is a state tax refund, a Form 1099-R for retirement distribution. We do have the taxable amount, and it's a code 1, which means it's an early distribution. We've got another 1099-R. We have the taxable amount, and it's a code 3, which means a disability distribution. Tuition statement for Alex, the older child. And we've got a receipt as well for some textbooks. and then an aftercare receipt for the younger child, Andre. And then finally, they gave us a void check. Essentially what this does is gives us their bank account information so that we can give them a direct deposit. We've got their routing number and account number. So we're doing the interview. We've got their identity documents. They filled out all their forms correctly. There's another thing we need to do before we move on to filing status and dependency, and that's determine if the return is in scope. So remember to pay attention to pages 2 and 3, and you'll see these B's and A's. So as you're going through and asking them these questions, you'll see which ones are basic and advanced. Wages are basic. Retirement income could be either, but we know from their forms that the taxable amounts determined, and we've got a code 1 and a code 3. As long as no exception applies for that code 1, that can stay basic. And in this situation, they used the retirement distribution to make improvements to their house, which there's no exception for that. Refund of state or local income tax is basic. Child and dependent care is basic. Contributions to a retirement account is basic if it's for the saver's credit, which we can check that by looking at their W-2s. This one didn't have any contributions, but Audra's does. She has that code D, just like we saw with Betty Baltimore. We don't need to do anything extra, but she might be eligible for that credit. And then finally, education expenses are basic. So a person with a basic certification can complete this tax return. So before we go into tax layer, we still need to do 2 more things. Determine who they can claim as a qualifying child or qualifying relative and their filing status. So let's see if we can do a little screen splitting here. Because we need our Pub 4012 to determine filing status and dependency. We always start with dependency. So we'll need this information from their intake interview form. Okay, so we'll go to tab B or tab C, table 1 for all dependents. So our first question is, can you or your spouse be claimed as dependent on another taxpayer's tax return this year? We need to determine that. You can see it's in this gray box. But because they're a married couple, they are supporting themselves and their family. Very unlikely that anyone could claim them. So we can say no and go to step 2. Now let's ask first about Alex, since he's listed first. Was Alex married as of December 31st of the tax year? It says single right here. So no, go to step 4. Was this person your child, stepchild, eligible foster child, sibling, half sibling, step sibling, or a descendant of any of them? We see here he's their son. So yes, go to step 6. Was he under age 19 at the end of the year and younger than you or your spouse? So his birthday's in 2005. It's 2000. When we're doing this, it's 2025. So he is actually probably 19. So he's not under 19, but is he under age 24 at the end of the year and a full-time student and younger than you? Yes, we know he's a full-time student because they told us in the interview and they indicated it here. He's at Towson. So we can move to step 7. Did the person live with you as a member of your household, except for temporary absences for more than half the year? They wrote that he lived in their home for 12 months. We remember that he is living on campus, but that's one of those temporary absences that's okay. If they're absent due to education, they still count as living with them. So we can go to step 8. Did the person provide more than half of his or her own support? We need to ask this question to the taxpayer and fill it in on the form ourselves. But we know from the notes that he did not have any job other than babysitting his brother sometimes, didn't have any income. So we'll go ahead and say he did not provide more than half his own support. And is the person a qualifying child of any other taxpayer? His parents are filing jointly. There's no one else who can claim him, so we can go ahead and say no, and we can claim Alex as their qualifying child dependent. All right, what about Andre? We see his birthday is January 20th, 2014, so he's like 10 or 11 years old. He's their son, lived with them 12 months. He's single. He's a U.S. citizen, resident of the U.S., full-time student, and he is not permanently and totally disabled. Can the Alleghenies claim Andre as a qualifying child? Nate says yes. Do we all agree? Yep, Stefan agrees. All right, we've got your backup, Nate, and you're right. If we go through this chart again, all the answers are exactly the same as they were for the other child, except he is under age 19. So we still say yes there and do it. But it is important to go through for each person and use this chart so we make sure we catch all the little rules. So we've got two qualifying children, Andre and Alex. Now we can determine filing status. Back to our chart. Were you married on the last day of the year? Yes, they're married to each other. Did you and your spouse live apart all of the last 6 months of the year? No. We know from this that they did live with each other the last 6 months and probably the whole year. So they can file married filing jointly or married filing separately. They came in together and they want to file together, so their filing status is going to be married filing jointly. So with that, we've answered our first two questions. Who can Alan and Audra claim as a qualifying child, qualifying relative? They can claim both their sons as qualifying children. And what's the filing status for Alan and Audra? Married filing jointly. Let's go through questions 3 through 6 before we go into the return, because hopefully we don't need the software to determine these. Okay, what do the box 12 codes on Audra's W-2 mean, and how might they impact the return? If we look at Audra's W-2, box 12, we see code DD for $8,400 and code D for $1,280. You'll start to get familiar with these codes, but we can always check in the publication 4012 what they mean. So it's actually under the income tab and under Form W-2 Reference Guide for Common Box 12 Codes, page D11. And you can see here, D, which is the 1280, is an elective deferral to a Section 401k cash or deferred agreement. 401k is a retirement account through your employer. So when we see code D, we think retirement and we think possibly eligible for the retirement savings contribution credit. And then when we see code DD, this is for the cost of employer-sponsored health coverage, not taxable. So that just means that she has health insurance through her employer. She pays it, and her employer pays part of it. She pays part of it. Who knows, honestly, but we just know that that's there. And that's important because for every taxpayer, as we go through the return, we do have to know what kind of health insurance they have, because for marketplace insurance, we have to do extra things. She has employer-sponsored health insurance, so we don't need to do anything further. Question 4 asks, what does code 3 on Alan's 1099-R indicate? And does it count as earned or unearned income? So drop it in the chat if you remember what a code 3 on a 1099-R indicates. Remember, Alan is working, but he was injured on the job last year. Nate says disability, not taxable. So yeah, that's right. Code 3 is for disability. It just counts as regular income. So it's going to count as earned income for him. He doesn't have any extra like early withdrawal taxes to pay. So we got to remember to take our extra step in tax layer and check off that box 3. All right, I think we have 2 more questions. That's exactly right, Nate. Best way to remember something is to get it wrong once. That's how we learn. All right, which child care expenses can they use towards the child and dependent care credit? Go back to the notes. Okay, so they both work during the day, and the younger son, Andre, who we determined is 11, attends aftercare until 6 p.m. during the school year, and it's $40 a week. Does that count for the child and dependent care credit? Nate's got his answers in. If anybody else? All right, Nate, you're exactly right. The daycare does count because Andre is under 13 years old. It was for care while the parents were working. And we know aftercare counts. The babysitting from his brother does not count because Alex is Audra and Alan's dependent. So you cannot claim the expenses that you pay to your own dependents. So we can't count that babysitting. And finally, do the Alleghenies qualify for the earned income tax credit? Why or why not? So you need to go back to tab I. If I can find it this way. All right. This is still H. That's why it's better to use the table of contents because this is just going to take forever. Okay, earned income credit. We need to determine if they're eligible for the earned income credit. So first, of course, rules for everyone. Does everybody on their return have a social security number? Yes. Are they married filing separately? No. Are the taxpayers U.S. citizens? Yes. They don't have any foreign earned income. I don't think they had any investment income, but definitely not over $11,000. And they're not the qualifying children of another person. So part A, we're good. Part B, rules for a qualifying child. They have 2 children who meet the relationship, age, residency, and joint return tests. So we're good there. Their qualifying child can't be used by more than one person to claim the credit. That's fine. And the taxpayer can't be the qualifying child of another person. Still all good. What we need to determine is if they're under the earned income and AGI limitations. So let's zoom in on that. They have 2 qualifying children and they're married filing jointly. So their income needs to be under $62,688. Of course, the software is going to do this for us, but since we're still learning, let's check out what their income is. Got $28,000 from Alan's work, plus $30,700 from Audra's. So right now we're at $58,720. We have this taxable refund of $2,400. We're not sure if that's going to be fully taxable yet, so we'll skip it for now. We've got another $2,000 in retirement and another of $1,160 in retirement for Alan's disability. So that adds another $3,200 about to our $58,770. We're getting close to 61. And then the rest is expenses. So it really all is going to depend on the taxability of this state income tax refund. They did itemize last year, so part of it's going to be taxable, and it might knock them over that $62,000 threshold. So let's go in and do the return and see if we get there. All right. So again, we need to be in TaxSlayer. You're welcome to log into your own account and do it alongside me, or you can do it afterwards for extra practice. Remember, the password here is train pro web in all caps. And then you should have your own password for your account. Okay, so we're starting a new tax return for 2024. First thing you need to enter is social security number, but are we good to do that? We've done an interview. We've determined it's in scope for the program and for basic volunteer. We have looked through the form and made sure everything's filled out. We've completed the gray sections. We've looked at their documents. We've determined their dependents. We've determined their filing status. We're all set to get started. So let's go ahead and find the social security card. Either of the taxpayer spouse, like either one can be that. Usually you just do it based off how they filled it out, and they filled out Alan first. So we'll put him as the primary taxpayer. Enter his social security number. Remember, the XXX means you can put any numbers you want at the end, since this is just practice. And then we'll go ahead and start return. Okay, that's just our warning that they're still working on the software. We'll skip it. We already know our filing status is married filing jointly. Then we need to enter in basic information. Remember, for the names, enter them exactly as they appear on the tax return. I'm going to put fellows right here so that I know that this is the one I completed with you guys, but obviously that's not his name. His social security number pulled through, and his birthday we'll find on this 11/11/1985. His occupation, machine operator. And then do we need to check any of these? Can he be claimed as a dependent on someone else's return? No. Is he a full-time student? No. He's not blind. He's not deceased. He did not want to contribute to the presidential election campaign fund. Not serving in a combat zone, not affected by a natural disaster, no digital assets. They don't want stuff in a language other than English. And he's not a non-resident. So we can leave all those boxes unchecked and enter his wife's information. On the intake interview sheet, they've got Audra Allegheny. On her social, she's got Audra Williams. If she hasn't gone and changed her name officially, she needs to still be on here as Audra Williams. So remember, always use the name on the social security card. Enter her social security number and her date of birth, which is 3/29/1984. She's a paralegal, we see from the form. And none of these checkboxes apply to her either. It's the same questions. And we know from the checkboxes on the intake form right here that we don't need to check anything. We need to enter their mailing address, 100 Main Street. There's no apartment number. And their zip code is 21501. City and state will automatically populate. And their telephone number, 240-11111. If they supplied an email, we would put it, but we don't have one here. It's no big deal. We can just click continue. Then TaxSlayer asks us if they have any dependents or qualifying persons to claim on the return. We already know they do, so we'll say yes. And let's enter the information for the two sons. Again, we check the name on the social security card. His name is Alexander, a middle initial A, and then his last name's Allegheny. Alex's birth date is 7/1/2005. And his social security number. This is all a lot easier when you're working with people in real life, and don't have to scroll up and down because you have the papers. Was this individual a U.S. citizen? Yes. Relationship, son. Number of months the person lived in the home, 12. And now let's check out our check boxes. Was this person over age 18 and a full-time student at an eligible educational institution? Yes. He's not disabled. He is their dependent. They want to claim him for their earned income credit. He's not married. He didn't have over $5,050 of income. And there's no multiple support declaration needed. That's for people who are being supported by more than one person or a married filing jointly couple. So we just check the first box, and then we can save a few seconds by clicking save and enter another. We can go ahead and enter Andre W. Allegheny. His birthday, actually, I'm going to do a social security number first. 228-00-111. And his birthday is 1/20/2014. He is a citizen. He's also their son, lived with them 12 months. And none of the check boxes apply to him. He's not a full-time student and over 18, not disabled. He is their dependent. They're claiming earned income credit for him if they get it. He's not married. He didn't have over $5,050 in income. We can click continue. We'll see both the dependents listed there. We don't need to do anything else here. Then we've got basic information. This is the spot where we would enter the IRS identity protection PIN if they had one. They don't. We see right here they checked it. But if someone comes in with an ID PIN, they'll have a letter, and you just go ahead and enter it under basic information. Okay, so now we can go ahead and start entering income. Let's start with W-2s. Because they're married filing jointly, we have to choose who the W-2 belongs to. Remember, we made Alan the taxpayer and Audra the spouse. So this one's for Alan. Standard W-2, that's the case most of the time. And then we want to enter the information exactly as it appears. So the employer identification number, looks like this number's already been entered in, and it's correct with what we have. So we can just leave that. That's a great thing that happens throughout tax season. The employee information is also already in there, and it's correct. So we are good there. We need to enter boxes 1 through 6. So his wages are $28,000. His federal income tax withheld is $2,800. Social Security wages $28,000. Social Security tax $1,736. Medicare wages $2,800. Medicare tax $406. These automatically populated. Typically 1, 3, and 5 are the same, but not always. So always double check it. He doesn't have anything in any of these other boxes, 7, 8, 10, 11, 12, 13, 14. So we can skip all of those. He does have state information, of course, so we need to enter that in. For Maryland, the state identification number, state wages automatically populated, and it matches, so we're good there. And then his state tax withheld was $2,500. All right. His W-2 is good to go. We do have another one, so you can just click save and enter another. This one is for Audra. So we choose spouse. And then we're going to enter her identification, the office's identification number. We've got another automatic pop-up, and it's correct, so we're good. Her information is correct. Then we enter boxes 1 through 6. Her box 1 is $3,720. Box 2 is $3,000. Her box 3 is not the same as box 1, so we need to delete what was automatically populated and put in $32,000, $1,984, $32,000, and then that changes to $464. We're good. She does have information in box 12. So 12A has code DD for an amount of $8,400. And box 12B has code D for 1280. Box 13 has retirement plan checked off, so we'll do that. Nothing in box 14, but we do have to enter our state information for Audra's W-2. $30,720 and then 3,200. That's our last W-2, so we'll click continue. We'll see them both listed here. Our next thing is the 1099-G. So thankfully that's right here, Form 1099-G, Box 2, state or local income tax refunds. Remember, if they did not itemize last year, we don't need to include this at all. But we know from their interview notes and looking at last year's return, they did itemize last year. They brought in the return and it shows us the information we need. So we do need to go ahead and do this. We have the information, so we're not going to use the bypass state refund worksheet. We're going to go ahead and fill out all of these boxes. State and local refunds is from the 1099-G. It's $2,400. And then the rest of the information comes from their prior year return. So we have the information up here. Schedule A, line 5D, 3,800. Form 1040, line 12, 29,950. Schedule A, line 5A, 5,500. And there was no prior year sales tax deduction. Their filing status last year was married filing jointly. And neither of them were over 65 or blind last year, so we do not need to check these. All right. We have some income from retirement accounts. This is from Audra's retirement account, $2,000. It's all taxable. She had a little bit of withholding, distribution code 1, which means an early distribution. And we asked and we know it's for home repairs, so no exception applies. Remember, you check for those exceptions in the Pub 4012. But we can go ahead and enter Form 1099-R, add or edit a 1099-R. This is in Audra's name, so we choose spouse. And then we go ahead and enter the information as it appears on the form. It automatically populates for me, which rocks. Gross distribution is $2,000. Taxable amount automatically pops up as $2,000. And we see that's correct. Next thing filled in is box 4, $200 withheld. And box 7, code 1. Nothing else is filled out on here, so we can go ahead and click continue. And we get asked this question. Our distribution code in box 7 indicates an early distribution. It lets us know it's subject to a 10% early withdrawal penalty. And it's automatically going to calculate the penalty for us. Then it asks, what type of plan did you receive this distribution from? Retirement, qualified tuition, or Roth distributions after conversion? Almost always it's going to be a retirement plan. Qualified tuition is like a 529 plan where you're saving for education expenses. Roth is a unique type of retirement plan. Then it says there are certain circumstances in which the IRS will allow you to make an early withdrawal and not have to pay the penalty. If you're not sure what qualifies to be exempt, you can click here, but we are sure. We already checked, so we're good. It just also reminds us if there is an exception, we need to fill out Form 5329, which we'll learn in advanced training. All right, and then final question about this retirement with distribution. Did you make an early withdrawal from a retirement account due to qualified disaster? No. We'll click continue, and we see the whole form is there. We have another 1099-R for Alan, so we'll add another. Alan's the taxpayer. Payer ID. We got an automatic population again. And then the gross distribution is $11.60 and 34 cents. Whole thing's taxable. We had $100 of income tax withheld in box 4. And then box 7 is a code 3. There's nothing else on the form itself, but because of code 3, remember we need to look at the rollover and disability section. Check here to report on Form 1040, line 1H, distribution code must be a 3. That's his disability income. We'll click continue. It says there's concerns. You're going to get this pop-up whenever you put a code 3 in. And check the box. So it just makes sure that you're correct. Says, yep, we're good. We can continue because we know we're right. We did not take this for a qualified disaster. Now we've got 2 1099 Rs. Okay, I think that's it for our income. So we're done with the income menu. Let me double check our form. Let's see, we did put in 2 W-2s. We put in 2 retirement distributions. One was disability. We did put in a refund. And we don't have any other income because we already went through and checked. So we're good. Now we can go to deductions and start entering our adjustments or credits. Let's start with the education credits for the son. This is from Alex's college education. We got a tuition statement and we know he paid some expenses. They paid it for him actually, and he's got some more expenses right here on our receipt. So remember, for education, it's a deductions, then credits. Then we choose education credits. And we start to answer a few questions. First, we need to select who the education credit will be for. This is for Alexander. It's 1098T is in his name, and he's the only full-time student. Did the student receive a Form 1098T from the educational institution for 2024? Yep. Did the student receive Form 1098T from this institution for 2023 with box 7 checked? This is not that. And it's typically not going to be the case. This is only for people who paid in advance last year, but it's not the case here, so we'll say no. Then we need to enter the institution name, which we have on this form. Towson University, 8000 York Road, zip code 21252. And then the employer identification number for the university. That's right here. Filer's employer identification number, 7700001234. We click continue. And now we need to actually enter the expenses. Tuition paid. That's going to be box 1 right here. This is payments received for qualified tuition and related expenses. So we'll put 6,200. Grants and scholarships. That's box 5, 3,000. And then other qualified expenses. So we learned in the interview that Alex had to buy some textbooks for class, and he has the receipt. So we'll put in his other qualified expenses as $256.48. Remember, the type of expenses depends on which credit they get. We've got to work out ahead that we think he's going to get the American Opportunity Credit based on his situation, and we know this counts. If he was only eligible for the lifetime learning credit, these would not count because they were not required to be paid to the institution. He bought this from textbooksunlimited.com. All right, now we have to answer our eligibility questions. Has the American Opportunity Credit been claimed on 4 prior tax returns? No, he's only a sophomore, so he definitely hasn't had it claimed 4 times. Was he enrolled at least half-time? Yes, we have this checkbox in box 8 that says he's at least half-time. Did he complete the first 4 years of higher education before 2024? No. And did the student have a felony drug conviction before the end of 2024? No. All right, so then TaxSlayer recommends that we take the American Opportunity Tax Credit. It's worth $2,364, as opposed to the lifetime learning credit would be worth $691. We definitely want that one, so we leave it checked and click continue. We can leave our summary behind. And now we want to enter the child independent care credit information for the aftercare they pay for the younger son. So we're still in credits. Choose child independent care credit. We need to enter the information from the form. So the EIN, which is the employee identification number, provider's name, the address, and a zip code. You don't have to enter the phone number. It's not required, and the provider is not their household employee, so we can click continue. Then we have to select who the expenses were for. Andre's the only eligible person based on his age and disability status, so we check him, and then we put the total amount paid, which is $1,440. Remember, we cannot include the extra babysitting expenses because that was paid to their own dependent. We click continue. Then you have to answer a few follow-up questions. Did you receive any dependent care benefits from your employer that are not reported on your W-2? No. Were you or your spouse unable to work due to being disabled or enrolled as a full-time student? No. Did you pay any care expenses for 2023 and 2024? No. Okay, so that's in. The last document we have is their void check. Let's double check our intake form to see if there's anything else we should be entering. We did the child independent care credit. We did the contributions to a retirement account. That was just on the W-2. And we did the educational classes. So double check every note we took. I think we're done. So we're done with deductions. We don't have anything to put in other taxes, payments, or miscellaneous forms. We can move on to health insurance. We know the entire family. What? Sometimes TaxSlayer does this to you. The entire family was covered by Audra's employer-sponsored health insurance plan. I hope it's saved for us. Yeah, there we go. So we can go ahead and, once we're back in, answer the one health insurance question we're asked. Which is, did you, your spouse, or a dependent have insurance under the Affordable Care Act? That means they have a Form 1095A and they purchased insurance through the marketplace. The answer is no, because she has employer-sponsored health insurance for everybody. Then we would complete the state section. This isn't available right now, so we're going to cover that in advanced training. And now we can take a look at our return. So if you're the first person preparing the return, not the quality reviewer, you're going to just go through and make sure everything looks right to you. At this point, you do not share the refund amount with the taxpayer. That's something the quality reviewer will do. But we will go through, make sure we've got all the information right up here. The filing status is correct. The dependents are listed correctly. We see that Alex counts for the child for the credit for other dependents. That's because he's over age 17. And Andre counts for the child tax credit. He's under 17. Line 1A is the amount from both of the W-2s added together. Line 1H is that disability payment on the 1099-R. Line 5A is the distribution that Audra took out of her retirement account. And then line 8 is additional income from Schedule 1, line 10. We can see that if we look at 3, Schedule 1, line 10 is the total, and that's coming from their taxable refund from the state level. So it looks like $2,250 of that was taxed. Then everything gets added together. Their standard deduction is $29,200. So their taxable income for 2024 is $34,930. Page 2 shows us the tax, $3,727. They got the child tax credit and credit for other dependents. $2,021 was applied here. Some amount from Schedule 3, line 8 was applied, which if we go check, line 8's the total, but it's coming from the child independent care expenses credit, $288, and education credits, $1,418. They then have other taxes of $200. That's the 10% tax from the retirement distribution. So their total tax, most of it was eliminated by the credits, the non-refundable credits, but they still have to pay that $200 tax on the retirement distribution that was early. But then we need to look at their payments. They had $5,800 withheld on W-2s, $300 withheld on their 1099s. That was the retirement accounts. They get the additional child tax credit, $479, and the American Opportunity Credit, that's the education credit refundable portion, $946. So when all of those are added together, they're getting a refund of $7,525. No, sorry, $7,325 because we subtract the $200 tax they owed. So we see that that looks good as the preparer. We need to go through and complete the e-file section before we pass it off for quality review. So first we need to say, how do they want their federal refund? They told us on the intake form they want direct deposit. Click continue. No fees because we're a free program. Bank account information. So let's find that. They said on page 1 of the intake form, if they're due a refund, they want it direct deposited. And they didn't say split between accounts, so they just want it all in one account. They brought us a void check, so we know the numbers. It's a checking account because they have checks. Their bank name doesn't say on here, so we'll just make it up. Usually, obviously, it will say, and you can just ask. We'll just put bank. Their routing number is the 9-digit number. Routing numbers are always 9 digits. You have to enter it 2 times. Bank account number is the other number. And again, we have to enter that twice. When you are looking at a check for the bank account information, a lot of people just have it on their phone or something nowadays, right? Or they have it written down. But if you are looking at a check, remember the routing number is first. It's 9 digits. The account number is next. And then the back number you don't need. That's the check number itself. But we've got it in there. The deposit amount is the entire refund. So we can just click pull refund. It'll automatically populate. They don't want it in another account or a paper check. So we can click continue. Oops, this is not a valid number. Okay. So obviously would not happen in real life because the routing number will be real. Oh my gosh. Oh my gosh. Okay. I'm just going to Google a routing number. Okay, we'll use this one. You can also always Google routing numbers, which is a helpful thing if someone doesn't know theirs. You just Google the bank name and the state they put the account in. Okay, we're through. Custom credits, we can skip. When we are at the tax site, there will be questions here we need to answer, but they're all going to be reported on a survey. And then we get to our submission page. Remember, as the preparer, we don't need to print anything. We just need to go here and click mark return as ready for review. And then you can go ahead and save and exit. The quality reviewer will do their quality review. We'll mark it as complete and then save and exit. The e-filer, so the site manager or whoever's assigned to e-file that day will actually do the filing. All right, so that's it for Alex and Audra Allegheny. And that's actually it for us today. I am going to send the answer key for Betty Baltimore as well as the Alleghenies to you all in an email. And then I'm going to send one more practice scenario that's Martha Montgomery. So for the homework this time, what you're going to do is complete both the Alleghenies and Martha Montgomery. There's still some questions to answer for the Alleghenies, and then do the whole Martha Montgomery exercise. At this point, you are welcome to begin your IRS certification tests on Lincoln Learn. And I'll send the instructions for that. If you're not feeling confident yet, don't worry. We have the rest of this month and January. But you can create an account and start taking those. And then our next step is our advanced tax law training for the PG County and Baltimore County DSS folks. You all are going to be joining us December 16th through 19th via Microsoft Teams. You'll get the invite for that shortly. And for the Maryland Community Fellows, you are welcome to join us for those sessions, or if not, Sadiq has independent study plans for you all available. So follow up with Sadiq if you're a fellow. But look out for an email from me today. In the meantime, we're not getting back together for a few more weeks, so please take some time to review everything we've covered. You can also review the study guide that you received at the beginning of the first training, and do some more exercises independently so that you really feel like you have a strong grasp on the basic tax law concepts before you head into advanced tax law training. You can always email me with questions. We can set up a one-on-one meeting too if you want to go through a tax return or anything like that. So just keep me posted. But for now, we're done for today, and we'll go ahead and log off. But I'll see everybody who's a core member on December 16th. Thanks, y'all.